Hey, let's talk about life insurance cover today. What is it? Who needs to buy it? When to buy? How much to buy? Age to cover? Which riders to include? There's so many concepts we need to understand. Most important, please pause and go through our disclaimers here. We are not responsible for the outcome of your actions. So basically, there are five types of life insurance plan. One pure term plan, two unit link insurance plan, third child plan, fourth endowment plan, and fifth retirement plan. Nearly all insurance agents and the financial advisors who are also an insurance agent will sweet talk you to buy one of the last four. But the only life insurance you need is the first one, a simple term insurance. Do not buy any of the other four plans. There are several other much better investment strategy for other goals like child education or retirement. You don't need to mix investment with insurance. Both have different objective and should be kept separate. But what is a term insurance? It's a pure risk cover that pays the sum insured to the nominee of the policyholder in case of death of the life insured during the policy term. In case the policy member survives till maturity of the plan, there is no payout. For example, X buys a term plan of 2 crore till the age of 60. Now, if he dies before the age of 60, the nominee will get the sum assured of 2 crore. And if X survives through 60, he will not get any money and the policy will get closed. Additionally, you can also add riders to your policy so that you can get a lump sum even in case of disability or critical illness where you lose your source of income. This will help cover your loan repayment if any and regular living expenses. We'll talk more about this in next slide. The objective of life insurance is to provide financial cover for yourself and your dependents to repay any loans or manage regular living expenses in case of death or even sudden loss of income due to critical illness or disability. Here you can choose the desired amount you need to cover, the desired age until which you want this insurance cover, and of course, in this pure term plan, the premium you pay is the lowest while the sum assured is highest amongst all five types of LIP. Now, who should buy a term plan? Yes, not everyone requires a term plan. You should buy a term plan only if you are the primary earning member of the family and also have one or more of these situations. You have someone financially dependent on you like your parents, spouse, children, or you have a large loan still outstanding like a business loan, house loan, or you haven't yet saved enough and built enough coppers through your investments to cover your future financial needs in case of death, disability, or illness. Most unpopular advice, but I suggest to everyone, discontinue the policy. Discontinue the policy once the applicable condition disappear. Like you are no longer the primary earning member, or you have fully repaid the loan and have nothing outstanding, or there is no person financially dependent on you anymore, or you have built enough corpus to support you and your family financially for life. When is the right time to buy a term plan? Once any of the above conditions get filled, ideally you should go and buy a term plan as early as possible because as age grows on, premium keeps increasing. With every 10 years of age, the annual premium cost may double. As life goes on, the risk of contracting diseases continues to move up. If you have some lifestyle diseases, the insurer may even refuse to cover you. Therefore, it is important to get a good cover quickly. One of the major questions which people do not give much thought to is up to what age should you get the insurance cover? Most people think they should get a cover up to age of 99 so that they can get a compulsory return on the premium paid. However, this is not a very prudent strategy. If you get a cover for greater than 60-65 years of your age, the risk of dying increases. It's obvious. Life insurance know this and increase the premium. And the returns on the premium can even be lower than an FD. So even if you consider inflation rate, the returns can go to zero or even negative. So a term plan is meant to hedge life risk. It is not an investment plan to get any assured returns. Again, don't mix insurance with investment. So the term plan you buy should cover you until you have any dependent person or any large loan liability outstanding. The most important question, how much cover should you buy? What should be the sum assured? Most people go with 1 crore or 1.5 crore or 2 crore as advertised and marketed by the insurance companies or as advised by the agents without any review of your financials. Some even apply a generic thumb rule of 15 to 20 times of your annual income. But to calculate this sum assured, you actually need to take into account your other investments, your liabilities, your actual net worth. So a good term life insurance will cover your estimated future living expenses plus net debt plus certain goals not yet funded minus usable assets you already have. So by net debt, I mean any loan amount above the value of asset which can be disposed or any loan on assets which cannot be disposed. Example, if you have a house loan of 1 crore on your self-occupied house, add this 1 crore in your sum assured because you cannot sell this house to repay the loan. But if you have a house loan of 1 crore for a rented house whose market value is more than 1 crore, then do not add this in your sum assured. Unnecessary, it will increase your premium amount. As in this case, you can repay your loan by selling the house. Rental income is anyway just 3-4% of the value of the house. So no point continuing a loan at 8 to 9% for a rented house. It's only increasing your cost every year. And as for assets, do not include the house which will remain occupied by yourself or family because that is not really an asset which you can use to fund any of your future expenses, right? Now the final question is which riders to add in your term life insurance plan. Riders are basically add-ons or additional benefits not covered in the base policy, which you can opt for to be included at very affordable rates. These are there are actually several riders available and not all of those are needed or have any utility. You should decide the riders based on your goal, the cost of the rider, need for the rider, and how likely you will need it. The three most useful riders in my perspective are waiver of premium, critical illness benefit, and accidental death and disability. You should not even look beyond this three rider and should not even consider beyond this three rider. Now, waiver of premium on critical illness is an important rider. I usually suggest people to add this. This rider will waive the burden of paying your future term insurance premium in case you're diagnosed with a listed critical illness or you are permanently disabled due to an accident. It ensures that your policy stays active even if you cannot pay your premium in such an event. The critical illness benefit rider helps cover a financial loss by having a fixed one-time lump sum amount in case you're diagnosed with any serious illness listed in the policy. Mostly it is the accelerated payment from your sum assured. Example, if your sum assured is 1 crore and you have this rider for 10 lakh, then you will get this 10 lakh when you're critically ill and your sum assured will reduce to 90 lakh. Now, if you don't want to reduce the sum assured, you can even buy this critical illness insurance cover as a standalone policy, and that actually has a better coverage of diseases. Now, accidental death and disability rider. All life insurance policy covers accidental death. But if you add this rider, the insurer will then pay up to the double of the sum assured to your nominee in case you die in an accident. And disability rider is helpful in case you become permanently disabled due to an accident. In such an event, the insurer will pay you a certain sum assured. So finally, to summarize at the end, term plan is the only life insurance cover you need to buy. Don't even consider any other type of life insurance. But buy this only if you are a primary income earner and have a dependent or a huge loan or lack of sufficient corpus. Discontinue the policy as soon as the applicable condition ceases to exist. It should cover you only until you retire and not beyond. So maximum up to age of 60 or 65 years. To calculate the sum assured, consider your net worth, your assets, your liabilities. Don't consider any other rider except waiver of premium, critical illness, accidental death and disability. All others are useless in my perspective. Now, if you have any further query or you need any services, you can book time with us at happinessmitra.com or WhatsApp number or email ID mentioned here. And don't forget to please share this video with your other friends, relatives, and connections. Thank you so much for your time and attention.